Welcome to the InterMarket Analysis video update. This video is designed to go through different areas of the market outside of the S&P 500 to try to get some clues about what's happening inside the S&P 500. We look at other stock indexes, we look at lots of different sectors, we even go into completely different markets, because sometimes when we look at these different markets, we can get some clues as to what's happening with the S&P. Another area that I look at in this video is valuation. How are we looking right now? Are we expensive? Are we cheap? Are we just about right? We go through the charts and look for those things to see what conclusions we can reach. This is being prepared for Monday, August 7th. The first area is S&P 500 valuation. This chart is a historical chart, meaning that we're going backwards in time to look at what were earnings like in the past. Usually you look back over the last 12 months, and that's called the TTM, or trailing 12 months. Then the market has devised this system called a PE ratio, and when we're at a certain level with the PE ratio, we're considered to be expensive, fairly valued, or inexpensive. A PE ratio typically over 20 means the market is expensive. Between 11 and 19, the market is fairly valued. 10 or below, we're considered inexpensive or cheap. Now, those are static numbers, and sometimes we can go way above those numbers. We don't usually go too far below them, but this is an area that the market has latched onto, and even though we don't use this to make day-to-day decisions, we might not even make decisions over a long period of time based on what we see here, but we just want to have an idea of where do we stand. This chart is suggesting that we are overvalued when you look backwards. We're above the PE ratio of 20. The black line is the S&P. Even though it came down this past week, we're above this red dashed line, which is the PE of 20. Just to get a little more insight, I take the value of the S&P 500 and I subtract the value of this dashed line to see how far away we are from that. When we're above zero, that means we're expensive. When we drop below zero, now we're coming down to be more fairly valued. Looking right now, even though we did decline this past week, the market is still considered expensive on a historical basis. We can also look at this going all the way back to 1980 and different events that have happened along the way and compare what were the PE ratios during that time. We also look at a thing called the Shiller PE ratio, developed by Robert Shiller, and a lot of people have found this very helpful. He uses more of a smoothed average over a period of time to try to take care of any outliers or strange situations. Currently, this reading is at 30.89. To give that some context, we look at the median and the mean. We're just a little under 16 and we're a little above 17. So we go 16 to 17 here, and right now we're at 30.89. So this way, on a historical basis, we're also considered to be expensive. We can look at other times. Black Tuesday, that was 1929. We're just a little bit above where we were at that time. The 1987 crash is marked right here, just to give us some historical context. But the market doesn't look backwards, they look forward. And so, based on analyst projections and forecasts and what they think will happen not only in the economy, but within each individual business inside the S&P 500, the market trades on forward PE ratios. We still use that 10, 15, 20 scale, but looking forward as of August 2nd, the S&P has a forward-looking PE ratio of 19.3. So we're just under that 20 expensive level. We also keep an eye on the mid caps. We're below 15 at 14.2, and small caps we're still below 15 at 14.1. Now, an additional chart that I want to include takes all of these different PE ratios and plots them together. The red line is the S&P 500. The blue line is the S&P 400, those are the mid caps, and the S&P 600, or the small caps, that's the green line, and we can get an idea of how they are related to each other. And then one final chart is the forward PE ratios just for the different small cap indexes. If you watch the daily videos, you know that I follow the S&P small cap index. There's also another popular small cap index called the Russell 2000. If we look at the Russell 2000, we have a PE ratio of 23.8. Well, some of the charts that I've been showing and some things that I've been suggesting in the videos suggest that small caps are inexpensive. Well, how can they be inexpensive when it's at 23.8? We look at the blue line, which is the S&P 600 small cap index, and that's where we get the 14.1, so we're right about fairly valued. Another area that we look at is growth, buy low, sell high, and value, things that tend to hold up better when the market runs into trouble. Typically, you will get dividends from this stock. It's a company that's been around a long time. Sometimes it's kind of boring to invest in this company, but when the market is having trouble, people go from growth stocks into value stocks. When things are starting to look more positive, they go from value stocks back into growth stocks. The first index that we look at is called a pure growth index, and it has been improving, but we're still in an overall downtrend. So growth is in a downtrend. The interesting thing is value's in a downtrend too. Even though it's been bouncing back a little bit, the blue line is still below the red line. What gets interesting is when we compare these two to each other. And I have a mirror image on this chart. On top is growth to value. On the bottom is value to growth. The reason why I do that, if you see this arrow and when we have the cross between these moving averages, they're slightly different. And so we want to have inverse charts sometimes that might tell us things that we may not see otherwise. Incidentally, there are some charts that come after this that I'm not using this time because there's erroneous data and the charts look so crazy we would just have a laugh instead of gaining some insightful information. We look at the pure growth index and compare it with the pure value index. We have been declining with growth and it is in an uptrend, but if we keep going down, we could see a death cross in this ratio. We look at an ETF, growth versus value. It's also in an overall uptrend and is holding up a little bit better. We look at value versus growth. That's an inverse, showing how value is now underperforming growth, and we've seen a recent death cross with this ratio. We also want to look at small cap growth versus small cap value. I show these in the daily videos. Longer term, we're still in an uptrend, but since about the end of March, we've been pretty much chopping sideways and have even been declining. Mid-cap growth, which until lately has been holding up a lot better, it's also in an overall uptrend when we compare growth to value, even though this past week we saw some weakness in this ratio. We look at a growth to value ratio using other tools where we have been outperforming with growth even though it's starting to pull back. An inverse of that same chart is value to growth, where it has been underperforming and starting to bounce up a little bit. Then this is the important one if you're following the S&P 500. This is S&P 500 growth to value, and the ratio is plotted down below. Kind of what we're seeing in other places. In the shorter term, you could say that's a downtrend. We've been chopping more or less sideways with a downward bias ever since about the end of March. But still, overall, this trend is going higher. We keep an eye on inflation. One area that we look at is the CRB index. This is a monthly chart where we're seeing this bounce up a little bit more and going above the moving average. We also look down at the bottom by looking at a ratio of inflation versus deflation, things that are in the CRB index. We came back up above the moving average, but we did decline this past week. The CRB index, these are different commodities. It continues to be in a downtrend, even though it's been seeing some recent strength. We look at the Baltic Dry Index. What does it cost to ship products from one place to another? When this is trending lower, that means inflation is subsiding. Some other markets that we look at, just to get some clues, we look at aluminum, which continues to be in a downtrend. Corn is also in a downtrend. Wheat is in a downtrend. We look at fertilizer, which is in a downtrend but starting to tick back up. Oil, and this affects all of us when we ultimately have to put gas in our car, and I'll have another chart of that. This is starting to come back and could be giving us a golden cross fairly soon. As oil was camped out around the 70 level for a while, now we're breaking back above 80. Here is gas, where we're still in an overall downtrend, but it has been spiking up lately. Natural gas really spiked up back in 2022 and then fell, and it's still in a downtrend. Heating oil really spiking back up, but still in a downtrend. Keeping an eye on diesel, where it's also in a downtrend, even though it's been ticking back up. Keeping an eye on copper. When copper is doing good, that means that economic forecasts are generally more positive. When copper is really struggling, that can mean weaker economic forecasts going into the future. On the daily chart, we did see a death cross here, and we're just getting ready to see a death cross on the weekly chart. Then we look at copper. Copper does really well when the economy is doing well, and sometimes it leads economic advancements, where gold tends to do better when we're having problems with the economy, so we keep a ratio of the two and see how it's performing. Copper had been underperforming gold for quite a while, but now we're chopping sideways, even though this ratio has gone back above the moving average. We look at a longer term version of this chart, and we also plot a 2-year yield and a 10-year yield. Typically, these three won't get very far apart from each other, even though they're on different scales, and typically they'll also move in the same overall direction. We're seeing a bit of a disconnect, where copper is starting to fall down, where the 10-year yield and the 2-year yield, not only are they inverted, but they're continuing to go higher. Here's gold, which is an overall uptrend by itself, but when we compare it to the S&P and even to the dollar, it's having a lot of trouble right now, and I'll show you that. Silver is also in an uptrend. Here's gold on the top and silver on the bottom, just their closing values. Down on the bottom, this is the correlation between the two, and you can see they might get out of whack with each other from time to time, but they're typically going in the same direction at the same time. Just to make it a little more interesting, we take a gold to silver ratio on top, and when this ratio is going up, that means gold is doing quite well. When this ratio is going down, that means silver is doing quite well. On the bottom, we can compare that to the dollar index, and a general observation that was made is when the US dollar index is going up, gold outperforms silver. When the US dollar index is going down, silver outperforms gold. Now, both gold and silver could be going up or both going down. It's just which one is outperforming the other one. We have a correlation of the US dollar index to the gold to silver ratio. Looking at the dollar, after dropping below 100, we were able to get back above that level. We even got back up into the 102s for a while. We ended up closing the week in the high 101s. Keep an eye on the euro. It's been declining lately against the US dollar, but overall it's still continuing to go up. Then we also look at the Japanese yen, which was bouncing up and is now seeing a little bit of weakness. Just to give some context, we have the euro and then the US dollar index on the bottom. Here's a standalone chart of the Japanese yen against the dollar, where it continues to be in a downtrend. But when we look at the British pound to the dollar, the British pound is really outperforming. Some indexes that we follow. This is the S&P 500, which is a weighted index. That means the big companies have more influence on what the S&P does. And then we also look at the equal weight index, where all of the stocks in the S&P are treated the same. We were seeing that the equal weight index was underperforming, but now it's been coming back up and pretty much following closer to what the S&P is doing. We want to see the equal weight index look really healthy in a good environment, because that means there's more broad participation by a greater number of stocks. One of the problems that we've run into in 2023 is there's a small number of stocks that are having major influences on the indexes, and that can skew what's really going on. We compared the S&P 500 to the CRB index ratio, and this is showing that the S&P is outperforming the CRB. Here's an inverse of that same chart showing how the CRB is underperforming. We look at the NASDAQ 100 and the S&P 500 and compare them. Now, up until this last week, both of them had been doing quite well, but the NASDAQ 100 has been doing even better. We're coming back down to this moving average in the overall ratio. Maybe this will provide some kind of support. The S&P 100 is back to outperforming the S&P 500. It was chopping around for a while, but now it's starting to go back up. But we're still working off of a death cross in this ratio. To be even more positive, we want to see the blue line go back above the red line. We look at small caps, the S&P 500. Longer term, they're still in a downtrend, but way over on the right, you can see where they're starting to show some improvement. In a good, healthy environment, we want to see the small caps participating. The NASDAQ compared to the S&P 500, both have been doing quite well, but the NASDAQ has been outperforming, and we came back down to this blue moving average. Maybe this will provide some support. NASDAQ 100 and NASDAQ have been doing well, but the NASDAQ 100 is doing even better and really outperforming. The 30 biggest software companies, even though they had some weakness this past week, they're still in an uptrend. The S&P 500 compared to some other stocks. First, we look at a broad advanced decline line study with the NYSE, S&P mid caps and small caps. We saw a little bit of weakness in all of the indexes, but they're still above the moving average. Mega cap growth. These are the big monster companies. They had a little bit of weakness this past week, but they're still in an uptrend. We compare the mega cap growth, the really big companies, with the equal weight ratio, showing that the really big companies continue to outperform. But we're seeing this drop down just a little bit as we see more stocks coming in and participating. The robotics and AI ETF. This is in an uptrend, but it has been falling back as of late. We compare this to the tech sector, and now it's actually starting to underperform. The S&P 500 to shorter-term bonds is still in an uptrend, even though this past week we did see a decline. We take a broad market ETF and compare that with further out bonds in the 3 to 7 year range. The ratio did come down, but overall, stocks are outperforming bonds. We look at the tech sector compared to bonds, where tech has been falling a bit, but overall it's still outperforming bonds. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, it looked like we were finally starting to break out, and that may still be true, but with the rest of the market having some problems this week, this index also came down. Low volatility stocks, which held up fairly well in 2022, were chopping more or less sideways, but we are still in an uptrend. But when we look at low volatility stocks and compare them with the S&P, the low volatility stocks are underperforming. The FANG index, these are the big companies, Facebook, Amazon, Apple, Netflix, Google, and a bunch of other things that are thrown into a new acronym. This index has been performing quite well and is in an uptrend. We keep an eye on ARK, which finally generated a golden cross, even though it's run into some recent weakness. Then we look at Dow theory, and we're seeing a breakout with the Dow. We're also seeing a breakout with the transports, even though they both have been pulling back lately. On the bottom, we see a real breakdown in utilities, and that often can give some good support to the S&P. Here's a new chart where I take the Dow and the transports and make a ratio. When this line is going up, that means the Dow is outperforming the transports. When this ratio is going down, that means transports are outperforming. In a more healthy environment, we want to see this ratio continue to decline, which is what it's been doing lately. Another thing that we look at are the transports to S&P 500 ratio. We want to see this going up in a really solid environment. And even on Friday, when we had some weakness, this ratio continues to advance. That could be further in the background as something positive. When we look at the S&P to the transports, we're seeing the strong relationship that they typically have starting to get a little weaker, meaning that they're not always moving in the same direction at the same time. We take a new type of Dow theory, where instead of looking at the Dow on top, we look at the S&P because that's a better representation of the U.S. economy. And instead of taking the transports, which at the time it was created meant the railroad stocks, they're not as influential as they used to be. Now we're more of a tech society, so we replaced the transports with the NASDAQ, and both of them are still breaking out and holding up, even though we've seen some recent weakness. This chart was out of order. Another thing I wanted to talk about with the FANG index is we did go back and set an all-time high and then immediately fell. And right now we're having a hard time getting above the previous all-time high as the market's been coming under some pressure. Then we look at the S&P 500 on a monthly chart. So this is pretty long term. And we look at an ETF that covers Europe, Australia, Asia, and the Far East. We're above this advancing red moving average, so that means price action is a lot more positive. We also look at a thing called the PPO, which is a momentum oscillator. It's starting to turn back up and we're crossing above zero. So in the longer term and in the bigger picture, the S&P is still holding up well. We also look internationally, where China's been going up. The emerging markets have been going up but are starting to roll over. We're seeing a little bit of a turn down in Europe, also a rollover in Japan, and we're starting to roll over now with the S&P in the US. We want to compare stocks versus bonds. This is a chart that I show in the daily video. It's a daily chart of the bond ETF. That means this is based on price. When we're talking about a bond yield, that means we're looking at the interest rate. We're seeing some weakness here, where we drop below the 200-day moving average. We're showing a death cross now in the overall trend. The MACD is negative, and we're showing some improvement with the RSI, but we're still below 50. The total bond ETF has been chopping sideways, and we're in danger of losing this uptrend. World bonds also chopping sideways above what had been previous support, and we could be getting ready to lose this uptrend. The stock to bond ratio on a monthly chart shows that stocks are outperforming bonds. Bonds are underperforming stocks. We look at high yield corporate bonds, which means junk bonds. They're continuing to have a nice solid uptrend. We look at investment grade bonds. They've been chopping more or less sideways, but are still in an uptrend. We look at riskier bonds like junk bonds and compare them with more conservative bonds like government bonds. And what's the ratio between the two? This has been going up, meaning folks are favoring riskier bonds over more conservative bonds. In a more positive environment, people are willing to assume more risk. Then we have a correlation between stocks and bonds, and they're having a fairly strong tendency to go in the same overall direction. When this is going up, that means they're in the same direction. When this is going down, that means they're going in opposite directions. The Dow Jones Corporate Bond Index has been chopping more or less sideways, but is still in an uptrend. The 10-year yield, we're coming back to this high and wondering, are we going to come down? Will we hit any of these fib retracement levels? Comparing the S&P to the 10-year Treasury yield, we're going sideways, but the S&P is still continuing to outperform. Looking at the long-term chart of the 10-year Treasury yield, where we saw for about 40 years a series of lower highs and lower lows, now we're starting to see things change a little bit. And is this some kind of a shift? Are we going to be in an environment where we see higher interest rates than what we've seen over the last 40 years? Looking at the 30-year yield, we're still above the 61.8% retracement level on the fib chart. Junk bonds continue to be in an uptrend. When we compare junk bonds with government bonds, junk bonds are really outperforming. And if you think about it, that makes sense. They're riskier and they give a higher rate of return. If a lot of people are jumping into them, which our other ratios showed us between risky and conservative bonds, this ratio should be going up, and that's what it's doing. A daily chart of the yields where we really climbed for a lot of the week, but then on Friday we saw yields coming down. A weekly chart internationally where the UK has the highest interest rates, followed by the US and then Germany. There's some interesting things happening in Japan right now. We want to keep an eye on this. The biggest owner of US Treasury bonds is Japan. If they start running into trouble and they have to start to sell the US bonds that they have, selling will make the price of bonds go down, which will make the interest rate go up. That eventually could bleed over into the US market. Looking at just a study of the 5-year yield, we're still above this dashed moving average. But when we look at the special K, which is a long-term momentum oscillator, we're in a decline. We're pretty much flat with the KST, which is another longer-term momentum oscillator. Another study of the 5-year yield on a weekly chart, we're still above the moving average. In the short term, we're starting to go more negative. In the intermediate term, we're turning a bit more positive. Longer term, we remain in a downtrend. Then, based on price, not yield, but based on price, we do another study of the long-term bond ETF. In the short term, the KST is just about getting ready to cross and show a negative trend. We are going in a negative trend in the intermediate term. However, in the long term, we are still in an uptrend. Then we look at a thing called the MOVE Index, which measures the volatility of bonds. We also look at a chart of the VIX, which measures the volatility of stocks. We want to keep an eye on the correlation. Are they going in the same direction or opposite directions? Right now, they're having more of a tendency to go in the same direction. Keeping an eye on the S&P 500 in different sectors. The materials sector has been chopping sideways. It's been improving a little bit, but it's still in a downtrend. Communication, one of the real strengths in 2023, continues to be in an uptrend. Energy, which was really strong in 2022, is now in a downtrend in 2023, even though we've seen a recent improvement with this ratio. The financials, which really got hit hard, showing some improvement there. When we look at just the financial sector by itself, we've just generated a golden cross. But when we compare it to the S&P, it's still in a downtrend. Industrials, not really exciting things to invest in, but it's still in a downtrend, but showing some improvement. The tech sector, another area of strength in 2023, continues to be in an uptrend, but saw some weakness this past week. We look at staples, the things that you have to have no matter what's going on economically. They held up fairly well in 2022. Now we're seeing them underperform in 2023. We look at real estate, which continues to underperform the S&P. The utilities are also really underperforming the S&P. Then we look at the S&P to utilities ratio in reverse. And when this line is going up, typically the S&P 500 is going up. And the inverse of that is also true. Now, we've run into some problems as of late with the S&P, but this ratio continues to go up higher. Will this give some support to the S&P when we're done going lower? Looking at healthcare, this is more of a value area because you need healthcare no matter what's happening economically, but it continues to be in a downtrend. Here's another look at healthcare, also showing the downtrend. Discretionary, the things that actually make life fun, they've been holding up fairly well, and they're starting to outperform the S&P, where a lot of other areas were down on the week. Discretionary held up fairly well. The staple sector, the things that you need to have no matter what's happening, it still continues to be in an uptrend, but it's been really choppy for most of 2023. The tech sector continues to be in an uptrend, even though it's seen some recent weakness. The semiconductors also in an uptrend, but some recent weakness. The tech sector to the S&P 500 shows that tech has really been outperforming, even though we dropped below this blue line in the ratio. Energy, which did really well in 2022, and tech, which is now doing well in 2023, is showing that energy continues to underperform tech, even though it has been bouncing up recently. Looking at growth, which means buy low, sell high, and comparing it with government bonds, growth stocks are really outperforming. The tech sector to the 10-year Treasury yield shows that the tech sector is outperforming the rise in interest rates, even though this ratio has dipped down. An inverse of that shows how the rise in interest rates has been underperforming the tech sector, even though it's seen some recent strength. Discretionary to staples ratio, we keep a real close eye on this. Discretionary had a golden cross with this ratio and continues to outperform staples. We look at an inverse of that, showing how staples are underperforming discretionary. Gold to the S&P 500. Gold's still in an uptrend, but it's really underperforming the S&P, and we've seen a recent death cross in this ratio. We're also seeing gold having difficulties against the US dollar. We can't seem to get above this layer of resistance. High leverage loans. These are considered to be risky loans, and if the economy was getting ready to fall apart, would we be in an uptrend? Probably not. The NYSE composite, a very broad measure of the market, continues to be in an uptrend. And we compare small caps to the S&P 500, that's the red line. We want to see this red line really go up. That would suggest a more positive environment. The blue line is the S&P 500. All stocks, which not only looks at U.S. stocks but international stocks, saw some recent weakness but is still in an uptrend. Emerging markets, chopping more or less sideways but is still in an uptrend. Bitcoin, which seems to have topped out and gone flat, has seen some recent weakness and is dropping below the 30,000 level. We look at an intermarket analysis chart going back to the beginning of the year. Even though we've seen some recent weakness, stocks continue to perform the best, followed by gold. Now oil has turned positive, the dollar is positive, bonds have turned negative but showing some improvement. Looking at some correlations, we compare the S&P 500 to the dollar. They're having a pretty strong tendency to go in the opposite direction. The S&P to oil, also a slight tendency to go in the opposite direction. The S&P to the 10-year yield, also opposite direction. The tech sector to the 10-year yield, opposite direction, but not really strong. The S&P to the 2-year yield, they're pretty much neutral right now, but they're having a tendency to go in the same direction. Then we look at the home builders. We have the S&P on top, which had a difficult week. The home builders have been holding up really well and actually ticked up this past week. The ratio did show a little bit of improvement. However, on the bottom, the correlation between the two is dropping off. When they're both going in the same direction at the same time, they're confirming each other. If they drop down below the zero level, that means they're going in opposite directions, and sometimes that can signal a negative divergence. But right now, we're not getting anything really insightful from this chart. Some long-term secular, which can mean decades, and cyclical, which can mean years, trend studies. We look at the NYSE composite on a monthly chart. It's above the moving average, and the Kopic curve on the bottom is crossing back above zero. This is turning more positive. Then we look at a daily chart of the NYSE, and then we look at a record high percent index. It continues to advance. We look at the S&P on a monthly chart and compare it with a monthly version of the PPO, showing that we're in an overall uptrend. We compare the price of the 30-year bond with the CRB, where we're seeing bond prices show some weakness, but the price of the long-term bond is still outperforming the CRB index on the ratio. Then we look at the S&P 500 and compare it with the CRB, which I show in some other places. This is a little different way to look at it, showing that the S&P 500 is outperforming the CRB index. Then we look at the S&P and take another look on a global monthly basis. We're above the red moving average, but the KST is still showing some weakness. So what is positive as of Monday, August 7th? My definition of positive for this value is when the 50-period simple moving average is above the 200-period simple moving average. We have the big software companies, the euro and the British pound compared to the dollar, gold and silver, mega caps, low volatility stocks in the S&P, the Dow Jones Composite Average, the FANG Index, as well as ARC, all the different bonds that we look at, the staples, tech and semiconductors, high leverage loans, the Dow, the mid caps and the small caps, the NASDAQ and NASDAQ 100, the NYSE Composite, all stocks, emerging markets, and Bitcoin. Then on the last slide, we look at what is negative, and that's when the 50-period moving average moves below the 200-day moving average. We have the growth indexes as well as the value indexes. They're still negative overall. It's just when you compare the two with each other, growth is outperforming value, where for most of 2022, value is outperforming growth. The CRB index is still going down. Copper's in a downtrend. The dollar index is in a downtrend. The Japanese yen compared to the dollar is in a downtrend. And microcaps are still under some pressure. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.